A momentous day for the Federal Reserve. For the first time in 10 years, the Fed raising interest rates. What does this signal? It signals that the Fed is confident the U.S. economy is performing well, that the job market is getting better. And the Fed Chief Janet Yellen even saying wage increases are starting to show up, meaning people are going to be paid more money. She talked about how the housing market is doing well, consumer spending is doing well, Americans are buying cars, the U.S. economy is strong relative to the rest of the world. Now, what are some of the drawbacks? Very closely watching inflation, very low inflation here. Is that something that will be a problem? Does that keep the Fed from raising interest rates further and more quickly? Another concern, people working part-time but would like to be working full-time. The Fed chief is watching that closely. Also watching something called the labor force participation rate, people who aren't in the labor market and maybe should be. But overall, the Fed is confident that the economy is strong enough that higher interest rates can prevail here. What does that mean for American consumers? It means higher costs to borrow money, especially if you have variable interest rate debt, variable interest rate loans, credit card loans, some small business loans. Maybe down the line you could see higher rates for car loans and for home mortgages. Those are things people will feel right away. But here is the rub. Many of the banks immediately raising the rates on what they charge people to borrow money, but they're not necessarily going to pay you more money or give you more interest on your deposits. That's one reason why bank stocks did so well. Christine Roman, CNN, New York.